Hello and welcome to the tax session of our Finance Directors Seminar. I'm John Endacott. I'm Head of Tax at PKF Francis Clark, and I'm going to talk to you about tax changes coming in the budget, starting with some more general comments around profit extraction, and then I'm going to move on to talking about more generally about the inheritance tax changes and the impact on succession planning. So starting with the budget more generally, I've got a slide here with a number of tax rates on, most of which did not alter in the budget. And this is split between basic, higher and additional rate taxpayers. And so we're looking here at the main income tax rate on pulling money out on salaries, bonuses, rent and interest. Then looking at the national insurance on those salaries and bonuses, what the income tax rate is on dividends, and then also the capital gains tax rate, assuming no business asset disposal relief. Now, what you see there is that actually there's been very little impact on overall profit extraction, whilst the employer's national insurance rate has moved up a bit from 13.8% to 15%. It doesn't really change the pattern, which is that there isn't much in it between dividend and bonus, certainly for higher rate and additional rate taxpayers. For basic rate taxpayers, there is more to have to consider on the individual facts, but if it's a 25% corporation tax rate, there's not that much difference in many cases. If it's a 19% corporation tax rate, then dividends win hands down. The significant thing that did come out of the budget, though, is that previously we had a basic rate tax rate or an income tax rate for basic rate taxpayers, which was 8.75% against a capital gains tax rate for basic rate taxpayers of 10%. So there was a bit of a margin with the capital gains tax rate being higher, but not much. Now we've got a capital gains tax rate that's twice as high as the income extraction rate on dividends for basic rate taxpayers. And that means that, curiously, for those taxpayers, they'd much rather have money as income rather than as a capital receipt. Whereas once you go to higher rate and additional rate taxpayers, there's a big margin still, even with the increase in capital gains tax rates, between income tax on dividends and the capital gains tax rate at 24%. So moving on and still thinking about capital gains tax here, we have had a tidy up in the budget with capital gains tax rates being moved up, and that was effective from budget day. Before, we had a plethora of rates split between shares and non-residential property, carried interest, and then business asset disposal relief and investors relief. Now, after the budget, what we've got is a basic rate tax rate of 18%, as I mentioned just now, and for higher and additional rate taxpayers, we've got a 24% tax rate. So a much simpler and cleaner position. The rates have moved up, but they're not as bad as was being implied that they could be. Plenty of damage done to the economy, probably in the process, with all the uncertainty and winding everyone up. But we've got to a position where there's a manageable level. Carried interest has got a higher capital gains tax rate now at 32%. That is going to change into a new income tax charge going forward. So it will then cease to be subject to capital gains tax from April 26 onwards. The details of that still being worked out. As far as business asset disposal relief in particular is concerned, old style entrepreneurs relief, that is still 10% until April next year. So there is a window to crystallize gains at that 10% tax rate. It's then moving to 18%, but over 2 tax years. So it goes to 14% in April 2025 and then 18% in April 2026. Now let's have a look at employers' national insurance. And this was the big story in the budget. And I've already mentioned about the moving up in the rate more generally. The rate moving up from 13.8% to 15%, it's unpleasant. It's not great. But when we had the social care levy, I admit that wasn't for very long, but when we had that, we moved to an employer's national insurance rate that was 15.05%, and it didn't cause too many problems. You could see that being copable with. The big issue is shifting the threshold. So what happens here is the threshold at which that employer's national insurance becomes payable moves down from 9,100 to £5,000 from April next year. What that means is you get to effectively a poll tax of £615 per employee who's earning over £9,100. And what that does is it makes marginal jobs more marginal. Now, there are complexities in all of this. There's exemptions for apprentices. There's a position whereby if you've only got small workforces, you get employment allowance increasing. So if you've less than 10 employees, less of an issue. And you've also got to factor in here that you could have younger workers who are then exempted from some of this. But if you ignore all of that and go to large scale employers where they've got a lot of relatively lowly paid people, this is a hell of a hit to their payroll. And particularly when it's combined with the proposed increases in the national living wage, both for the over 21s and for the under 21s. There's then the point as well that whilst this has raised a considerable amount of money, or is due to raise a considerable amount of money, it's not a great tax, as many economists have said. And even assuming that everything goes to plan on the government's numbers, it's implied in their figures that you might need to raise another 9 billion a year if you not have a bit of a restriction coming in the run up to an election, which seems pretty unlikely. So all the implications are that the government will be back for more, whatever they might say. I now want to talk about the changes to inheritance tax in the budget, and in particular, the impact on succession planning. And here, my focus is particularly on agricultural property relief and business property relief, APR and BPR. But the changes to pensions and those being liable to inheritance tax also has a significant impact going forward. So there's a there's an area here that clients really need to think about and consider and to factor into their planning, which I want to now set out and explain why I think those things are important. And I'm going to start by looking at a graph here, which is a bit of a busy graph, but it picks up actual figures that HMRC have. So this is a graph of death estate figures, and it plots them against the value of that death estate with the overall effective tax rate on the estate, how much inheritance tax was being paid as a percentage of the overall value of the estate. And this has been highlighted in the run up both to the general election and in the run up to the budget, because what the government would like to see is an increasing line so the tax is progressive. So it starts in the bottom left hand corner and it goes up to the top right hand corner. Whereas what actually happens is at the moment is it goes up more or less like that until you get to estates of about £2 million. Then it goes flat and then it drops down quite a lot. And the reason for that is because there's substantial reliefs on larger estates. And in general, those reliefs are agricultural property relief and business property relief. And the government feels that those reliefs are too generous to taxpayers and so wants to restrict those reliefs. So what's it going to do to restrict those reliefs? What we've got is changes coming in from April 2026. So this is 17 months or so away, but I'll come back to that in a moment. You need to be paying attention to it now. The way the government is approaching this is to say, well, okay, it's reasonable to allow people to have full relief so they can pass on a business and be protected from inheritance tax up to a certain figure. And they've chosen a figure of £1 million. And so up to £1 million per individual, and also per trust, we're being told, but per individual, we've got a position whereby you will get 100% relief, whether it's agricultural property relief or business property relief. Above that level, what you get is 50% relief. So still a very generous relief by historic standards. That allowance per individual on what we know at the moment applies to the death estate and also to gifts within the previous 7 years. As far as trusts are concerned, then each trust, and that's presumably a relevant property trust, will get a £1 million allowance. But if multiple trusts are set up by the same settlor after budget day 30 October 2024, then the £1 million allowance will be spread across those trusts. So you can't just set up lots of trusts to try and get more allowance. There's a question mark about what's happened about gifts in the last 7 years. We know that gifts after 30 October 2024 are within the new rules. Before 30 October 2024, we know there's no restriction, but we don't quite know how the mechanics of those rules work, and there's some different interpretations possible, which we're trying to clarify. We've also been told that the allowance is not transferable between spouses, although some statements by government ministers seem to cast doubt on that. And so we're pushing for clarification on that point as well. We've been promised more details in early 2025, but because these rules apply to decisions to make gifts now, we really need that information as soon as possible. As a firm, been pushing to try and get clarification from HM Treasurer already and using other methods to try and clarify the position, but so far without much success. What should you be doing now? Well, there's a number of immediate actions to consider. First of all, where you've got deaths within the last 2 years of, let's say, shareholders, or if it was a family farm, people owning in the partnership or owning land, it's very possible that you might have the death of a spouse who then leaves their estate to their surviving spouse. And that would have been a reasonable thing to do on the assumption that then when the second spouse subsequently died, they would benefit from the reliefs. Given what's happened now, if you're in that position and it's still within 2 years, you can do a deed of variation, and that might be wise in order so the assets don't go to the surviving spouse. If you're looking at owners under about age 60 or under their 60s, then life cover is probably a good option. And it won't deal with the inheritance tax position in itself, but it will enable you to protect the position, and it's probably pretty cost effective because a lot of planning could be quite expensive here. So life cover is definitely something to explore. There's a lot of detail around that, but it may be a cost-effective solution. And if you've got a company, it may be possible to write that in such a way that you're getting tax relief in the company on the life cover payments, premiums. If you've got a business that's worth less than £1 million, well, there isn't any change. The position's the same. You're still going to get 100% relief. Given who we're generally talking to as far as many of our seminars are concerned, our clients, and these seminars, we'd expect the businesses for those to be much higher than £1 million, and therefore we're looking at a number of other factors here. If the business is worth less than £2 million and you've got married owners, then you may well be able to deal with matters by just reviewing the wills, by trying to write the wills in a certain way, but you may have to put assets into joint names. So there's actions here required, and if that's agricultural land, that could be quite complex. If you're looking at businesses worth more than £2 million, then there are a number of options in order to try and further protect the business. First of all, there's an issue about reviewing existing wills. Now, many wills will say, I leave my relievable assets to so-and-so. And that needs considering, because the will may have assumed, because we've had these rules for 30 odd years that fully relieve those assets, that there would be no inheritance tax payable on those assets, and therefore they could be left wholly to a certain beneficiary. If a will's written that way, the danger is you could get to an inheritance tax charge on the first death, and one might want to alter that and leave those assets to a surviving spouse at that point. So there's a need to consider the wills and to understand whether there's any problems hidden within that. It's kind of the reverse of the deed of variation point. We've got a number of clients where we might have done restructuring to deal with succession, and where preference shares may have been issued as a means of providing for funds for the retiring shareholders, shareholder directors, but also still getting business property relief. Those arrangements may no longer work in the way that we intended, and therefore there may be a logic to people redeeming preference shares, particularly if they might have sizable pension funds, as they might be better off using the pension fund and giving away the preference shares, or redeeming the preference shares, getting cash and doing planning with the cash, either using that to plan for inheritance tax or just giving the cash away. Other options are making outright gifts to children. I'll come on to that a bit more in a moment. Hasn't just got to be to children. Yeah, making outright gifts, just passing assets on, or making gifts into trust. And in particular, there we're talking about relevant property trusts. And as I say, people need to consider their pension fund position and the very wide-ranging changes now being proposed to pension funds, whereby from April 27, they will be liable to inheritance tax, which is not a position that we've ever had before. Historically, before the George Osborne reforms, we had issues where pension funds for those aged over 75 could be subject to inheritance tax, but not on the under 75s. Now what the government proposes is all of them will be. And that will have a significant impact on inheritance tax planning for business owners. So let's consider the position of gifts pre-April 2025. Now, I've got quite a busy slide here, but it's helpful to try and understand the position. And I'm talking here about a gift of shares worth £5 million, and I've suggested the gift is taking place on the 5th of April 2025. For reasons I'll come on to, it would be better to do things sooner than that if possible, but the logic of picking that date is it makes this slide tidier and easier to understand. So it fits in with the tax years. And the reason for that is we're interested in the 7-year survival position, which is why we've got 7 columns. And so each year of survival ties in with a tax year in this example. The first thing you've got to look at is the value. So I've started this slide with the value of the shares, which I put at £5 million. Now, there's a lot of work to get to what the value of those shares are. There might be scope for us to argue down the value. For the purpose of this example, just assume it's £5 million. I've then taken off the business property relief. Well, in 2025-26, so if the person giving the shares away here died in the first 12 months, they would get full relief from inheritance tax, full business property relief, because they'd be dying before April 2026. After that, and in all the other columns, I've got £3 million, which is their £1 million allowance, because I'm assuming they haven't done anything so far, and it's all quite clean and simple. And then that leaves £4 million at 50% is 2 million. So it takes 3 million of business property relief off our £5 million of value. What that leaves is then £2 million being subject to inheritance tax. Now, bear in mind that it's easy to start to think that the business property relief isn't very valuable, but it's actually worth a great deal of money, because that £3 million at 40% is worth 1.2 million. So more than 50% of this gift is still being relieved, even with these less generous rules coming in. But going back to what I've done here, what I've then worked through is to say, well, what's the inheritance tax on that £2 million? So 2 million at 40% is 800,000. And I've then said, what's the effective rate on that? So 800,000 divided by the 5 million, the value of the shares, gets you to 16%. And then what I've done is I've worked my way out across my 7 years. And the crucial point here to understand is that it's not just about 7-year survival, where you've already utilized your nil rate band and you're making gifts larger than that. You get taper relief after 3 years, and that tapers down with 20% of the tax, tapering down, so that you go down on a sliding scale from year 3 to year 7. So in this case, what we've got is we go from 800 to 640 to 480 to 320 to 160. So the crucial thing to understand here is in my example here, you've got a 3-year period where you're exposed to the maximum level of inheritance tax. But because of the full business property relief for the first 12 months, you narrow that down to only being a 2-year period. Now, if you made the gift earlier than April, you couldn't get as much as half of that 3-year period, fully relieved, but you could make more of it. And then you're getting the benefit of the taper relief coming through. You could look at life cover. You haven't got to cover all the inheritance tax. You could decide to hedge and maybe insure 400,000 for 5 years or so. Whatever the decision is you're trying to make, what you can see is by taking action, there's scope to plan for this and do something sensible. It's now worth talking about trusts, and here I'm looking at a position whereby a trust owns shares in a company, let's say, or it owns agricultural land. And generally, we want to make sure that the trusts have always got liquidity, but you will come across examples where you've got trusts that only own agricultural land or only own shares in a company. And where there's been full relief for inheritance tax on that, that hasn't been a problem in the past. Trusts pay a tax charge every 10 years. There can also be some exit charges where trusts are broken and things come out, and some more complex rules there. But if we ignore those and just take the 10-year charge position, it is most likely, although we don't know all the full details, that where a trust has a 10-year charge soon after the new rules come in April 26, so it could be as early as 6 April 26 or 7 April 26, that 10-year charge will be the full 10-year hit. We need to see whether we can get any transitional relief on that, but the working assumption at the moment is that there wouldn't be. So what's likely to happen in that case? Well, I picked the value of 3 trusts, one of 2 million, one of 5 million, and one of 10 million. And I've assumed they've got a full nil rate band each and tried to give them full APR and BPR and worked out what the tax charge would be at 6% on that figure. So the 10-year charge is assessed at 6% on the relevant value after those reliefs in the nil rate band. And what you see is that on £2 million, there's an £11,000 to find. So irritating, but not really a big deal on £2 million. Once you come to 5 million or 10 million, you've got quite large chunks of change to have to find. I mean, at £5 million, you've got to find £100,000. 10 million, £250,000. So normally we're working with clients to make sure that we've got money in the trust ready to pay these liabilities. Here, what we could have is these trusts being subjected to large tax liabilities very, very quickly that are unexpected, and there hasn't been much time to plan for it. So there's effort needs to be done to plan for the tax charges concerned. What else should you be thinking about doing and considering here? Well, there are a number of things to pick up on, some of which I've already kind of covered, but just to kind of pick up in particular, looking further out. Minimizing the value of the assets is a key thing. Going further back to when I was much younger, we always used to try and argue down the value of the assets. What's happened in recent years is that because you get a probate value uplift for capital gains tax on death, the incentive has been to push up the value of the assets, but now we could get back to trying to push them back down. So could agricultural land fall in value? Yeah, it sounds like it could do. What could we do? What's the valuation mechanism in the agreements over the shares? How do they set the market price? What could you do to the articles of the company to try and restrict the market for the shares? Could you put in a bloodline restriction? What else could you do? How do you manage that kind of position? What else could we do to the share structure? Could we introduce some things like freezer shares and freeze the value of the shares in some way? This is all planning that we would historically do on investment companies, and there's a rule book for using it. It's just used on certain type of companies, and it's going to apply much more widely now. And yet the owners of those companies will be unfamiliar with these approaches. So one approach is to try and reduce down the value of the asset. Another is to try and spread that across family members. So what could you do with a partnership agreement? Could you bring other members of the family in? Could you give them more of the share of the partnership? How does that work? there's some scope to think about there for unincorporated businesses. But then quickly you'll get to conversations about pre and post nups. What's the position on, worrying about passing shares or property on, and then matrimonial issues or bad relationships. You also need to think about the wills of everyone concerned and to deal with that out. Other things to think about: might incorporation now make sense if it didn't in the past? Is that something to look at? What about reclassifying shares in certain ways? Could you have separate classes such as voting shares as a separate class, or capital rights shares as a separate class, income shares separately? How do you break those apart? Those are all things that we do for certain clients, got experience of doing. There is a window of opportunity in particular to do a number of those things this side of April 26. After that, that will get much harder. So to kind of conclude this bit and put it together, I want to I've described this as a possible idea, and this is more to try and illustrate some of the things we might look at. And this involves gifts to individuals and into trust prior to April 2026. But the key thing is we're looking at gifts into trust, and we've got an opportunity to do those before April 2026 based on what we know at the moment. So I've started with a situation where I've got mum and dad owning a business, so they own all the shares in a company, and those shares are worth £10 million. The business is worth £10 million. Mum and dad own 100% between them. So what could we be looking at here? Well, in this case, they've got a son who works in the company, and we're in a position whereby it works to pass 5% of the shares onto that son. And that's important because what I'm trying to do is to get to a structure whereby mum and dad have got less than 50%, and we've got two trusts that have both got less than 50%. So you need somebody else to be holding some of the shares. And so it does depend upon the family circumstances in these situations. But assuming that that works, and often you get some situations like that, my suggestion is that mum and dad pass 5% of the shares to the son, and then they give 49% of the shares into trusts, one by mum, one by dad. Where would that get you to? So where that gets you to after that, and there's a 7-year survival required here, but I'm assuming mum and dad are young enough that that's a reasonable thing to go for. If you look at the share position, the percentage of shares held after those gifts, you'd get to mum and dad having 23% each, the son having 5%, and each trust having 24.5%. If you do that on pro rata value for the £10 million, you get to 2.3 million, 500,000 and 2.45 million. But when we're looking at those shareholdings, we would apply a minority discount. And I picked some minority discounts that not meant to be unduly aggressive. And where that gets to, let's take Sun first. Sun's only got 5% of the shares. It's a trading company. We'd probably be looking at a minority discount of as much as 90% on that. And one of the reasons why you could be a bit more relaxed, particularly if the articles are written in the right way about the son having some shares, even if you're worried about matrimonial problems, is because you could always buy back the shares or do something else because the value wouldn't be that high. But what you can see there is we get into a position where each trust has shares worth less than £1 million because we could apply a 60% minority discount to that. In this case, each trust probably would be able to go up to about 1.3 million. So we could go higher than a 10 million value still at these numbers. Mum and dad get a lower minority discount because we have to lump together their holdings. So we're actually looking at a 46% holding. And they'll be at 1.38 million. So 380,000 over the 1 million. But if you then consider that 50% of that 190,000, 40% of 190,000, it's about £70,000 or so, £80,000. You're getting to manageable numbers of something that you could kind of cope with, and that we've managed the position. So yes, there's 7 years survival. Yes, there's a whole lot of other factors to consider, but there's a lot of things we can do, which means that where you've got companies and situations, even with the values going up to 15 million, 20 million, there's still quite a lot we can do. Above that, things get much harder, but there's still tactics for us to explore, and therefore we're interested in having conversations about those situations. And we're actively already working with our clients to try and help them deal with the position that they're now in following the proposed budget changes. I hope that's been interesting. I hope you've taken quite a bit away from that. Appreciate there's a lot of numbers and a lot of complexity to it. We're here ready to talk to you if you'd like to talk to us. Thank you.